Good evening, everyone. Hope everyone is doing great. Today we're going to talk about markets. But before that, I would like to go over past and upcoming events that we had in our company. Next week on Wednesday, we're going to have a webinar on health insurance during COVID, during quarantine, and how to travel, what insurance to use. And we would like to welcome you to this webinar, and it will be in Russian, and we can send out the recording. It will be on Wednesday at 8 p.m. Moscow time. Also, last weekend on the 20th and 21st of June, we took part in a big event in Russia. It's called Portfolio Investments, and there were more than 500 participants. And we listened and talked about portfolio investments during crisis, and all the financial advisors talked about what are the portfolios that would they suggest about dividend investments, about different structures, but they also talked about what financial advisors are doing during current situation. And one thing that I want to point out is some presentations that people had on laws, on new laws, and especially on tax laws. I would like to remind you that from starting next year, there will be reduced tax for non-residents, which is same as residents. Russian residents and Russian non-residents gonna have the same tax, which is 13% on capital gains, on dividends, on coupons, just all across the board. So that's kind of good news. And the other good news is the Association of Financial Advisors received a letter from a letter confirmation from Federal Tax Authority, Federal Tax Service, where it says that unit-linked programs, I'm trying to find it, unit-linked programs and unit-linked insurance policies are not treated as bank accounts, are not treated as individual accounts, so they do not have to be reported, and we do not have to declare every year any income or capital gains on it. So this is all from me, and I would like you guys to take the mic so we can talk about the financial markets now.
So Mike wanted to present something, but what you're saying is the tax rate goes down for expatriates living in Russia as residents. It goes down, or non-residents, it goes down from 30% to 15% next year. So Russia becomes kind of a big tax haven. So
yeah,
it's kind of a big thing, right?
Yeah.
Okay. I think it was 13% anyway.
13%,
they were resident.
Yeah, it's 13%. It goes down to 13% for everyone.
Yeah.
But it was more for non-residents investing in Russia. So collecting rent from an apartment, for example, was classed at 30. Or if you're not permanently resident or resident for more than 183 days in Russia, then you're taxed at 30%.
Yeah, especially if you invest.
For like part years, for example, were a big one that you got taxed at 30% for the first 9 months until you basically established residency of Russia.
Okay.
Yeah.
So Mike, you had some slides you want to talk about, follow up from last week, I think. You're our treasury bond guru.
Green, yes. Great. So just to come back to the question of, I've not slept all week worrying about Alan's thesis of doom and gloom, and this is why I look like this, and it's dark behind me. But
quite right.
Now, what's interesting is also there's nice pictures of my colleagues appear over my notes on the screen. So really, we're spending a lot of time worrying about everything going south in the next 5 minutes. A lot of my clients the ones who've come back into to invested in the last post-crisis 6 or 7 weeks, everybody's concerned about things being toppy, things being frothy, about volatility still being high, and volatility still is high. But in fact, when you look at this, for example, is a graph of valuations of each country's compared on a so compound annual price earnings growth basis. When have things been cheaper than now? In other words, how expensive are things? And you can, on the left of the screen, you can see US large cap over 90% of the time has been cheaper than it is now.
Mm-hmm.
So yeah, US large cap is fairly fully valued. And all of these lines, they don't really make a comparison with each other. They are individual countries, and you're comparing the dark blue with the empty space per country. So you can see, for example, Russia is has been cheaper than it is now 55% of the time, more expensive than it is now 45% of the time. The really
cheapies,
the countries where things assets are really cheap at the moment is most emerging markets. It includes India, it includes Mexico, Japan, Indonesia, South Africa. Europe, assets have been cheaper 30% of the time. Sorry, more expensive 30% of the time. So this overvalued thesis really is quite geography specific, and we'll see in a minute sector specific. Because if you look here, this is a graph of index performances since the pre-COVID-19 peak, and the white one at the top is our FANG favorites: Facebook, Apple, Amazon, and so on. Now, this has clearly exceeded its pre-COVID peak. But look at the others in here. Russell 2000, for example, still some considerable way to go. The reason people talk about it is because the increase from ground zero for stocks has been enormous. But this is a long way from where it was before the crisis. And if you normalize the interest rates, I would say that normality was somewhere up here. So, and the same is true, for example, if you look at the all-world index, excluding US, you're here on the purple line, same story through, and then, so toppy, then S&P information technology sector. So we can see US tech and large cap is what's leading the overvaluation hypothesis. Mm-hmm. Now, this slide is from Bloomberg, but was also came up in a conversation Alan and I had with Andre Movchan earlier today. Where are we with the equity risk premium at the moment? And in fact, it's running at around 4, which is by no means excessive compared to history at all. So what's the theory? If you're worried about things where things are now, I would say look outside tech, look outside the US, look away from bonds, and look towards value. And this is an interesting discussion with Movchan, was what happens when eventually quantitative easing reverses, when so assets are being sold back to the public and the prospective raise in interest rates comes along. Well then, be prepared potentially for up to 25% decline in equity valuations at that point.
Mm-hmm. Okay. So the idea that we've talked about at least twice in the past on these Friday events has been look towards value, get away from these ideas that the tech is going to be the sector that continues to lead. Although right now, that's an early view to take, because tech is the leading sector. If you look at today, absolutely, markets are collapsing. Down 2% again on the S&P. IWM, or the small caps, is down further. But what goes up is Amazon, because as you stay home, certain companies, cloud companies, big tech companies, social media companies, these are the ones that are doing the heavy lifting and keeping the markets afloat. if it wasn't for these companies, you actually see the markets would fall much more, because they make up now 25% weighting. I mean, the FANG stocks make up 25% weighting in the S&P, and much more than that in the NASDAQ. And so the outperformance we're seeing is a momentum play. It's staying with the momentum stocks. It's actually keeping the markets up, and it's these other stocks like airlines and cruise lines and oil and gas companies and all these other things that are extremely historically valued right now. They're a value play. But I mean, is there growth anywhere in those companies right now? There's no growth, so it's hard to say that this is a great time to rotate into into those value.
The timing of the rotation, I think, is the $64 million question.
Exactly, and when that's going to happen, you know, especially as we see more cases of COVID coming. And I'll take over here, Mike, for a second, and just show real quick what I've been up to. So I wrote this, you know, I wrote this blog yesterday, I think, about what it's like right now investing, and what we can be aware of or should be mindful of in going forward. And basically, we should be mindful of, in the United States, you're seeing a lot more cases of COVID, and in specific, in specific places like California, you can't probably see the graphs really well, but Texas, Florida, Georgia, these places are, some of them you would consider maybe a second wave, but I mean, a lot of times the wave hasn't stopped, or it actually is just gaining momentum in these. And so you places like New York, Connecticut, New Jersey, Governor Cuomo actually came out and said, you know, we're going to try to stop interstate transactions or transit between these states. They're shutting down airports. JetBlue Airlines, that usually flies between Florida and New York, went down 9% in one day because of this. I mean, this is kind of like, okay, where is the normalcy in the economy? So you have the COVID issue. We had issues about murmurs overnight, one night, about China not keeping up its end of the trade deal with the U.S., so that presented a problem. Navarro came up with some comments that he walked back after Trump immediately got on Twitter and said that's fake news, and we're going back and forth. But the reality is there's something going on with China that, you know, today again they're threatening to use economic warfare against the U.S. political involvement in places like Hong Kong and Taiwan. Trump is not going to be reelected. If today was going to be election day, Trump will not be reelected. It's I think he's got less than a 10% chance of being elected on most polls right now. And unless that changes, this is bad news for the economy. It will means potentially that the House will be controlled by the Democrats. The Senate might be disrupted and controlled by the Democrats. That means the presidency could be also Democratic, run by a 77-year-old president, arguably not in the best state of mind. Who's going to be the vice president is a big question in the United States. And with all this uncertainty and the fact that they're going to probably, the Democrats, if they do take control, are going to change a lot of things. There was even talk recently about Warren becoming the Secretary of Treasury, which means there would be higher regulation of banks and all kinds of new laws. This is really bad for the market. This is, if this continues going forward, fundamentally, this is a backstop. The backstop for the growth in the economy is really going to fall apart. And so what I'm seeing, or we've talked about in the past, is this market weakness across the board in the summer months, and a lot of volatility, a lot of choppiness, and some of those signals are beginning to play out. So one of the things I put on Telegram the other day was, let me see here if I can, I don't have to find it in Telegram, I'll just show it here, that this McClellan Index, and I think I talked about it in a blog or somewhere, but you're watching some of these indexes roll over, or these indicators roll over from very high levels. They're rolling over and giving bearish signals on the market, and the market really hasn't sold off yet. But if you look at the downside, just a normal trough, you can see that we've got a long way to go, and this could play out with a kind of negative few days, at least a negative few weeks. So even though we're headed into July 1st, a very bullish month, that we still have to get through today and tomorrow and Tuesday. So I would expect some choppiness in the markets. I would expect us to be careful of what we present as completely bullish. And even though we look at this value growth play as a potential way to see that if the markets do pull back, maybe you're going to see the money flow out of the FANG stocks and maybe pick up some of this value stuff that's undervalued. And I know Alan was looking at MLPs this week, and we've talked about dividend stocks in the past, but those are some of the sectors that might pick up or get a bid because other stuff is just so overbought. We were looking at Shopify today. There's some traders in it. They were like their PE is 20. No, not PE. Price to sales is 23 times sales, based on 2023 sales. This is like insanity. Like the way things are valued in some of these like online internet businesses is really outstanding. Now there's growth there, right? Shopify is growing, Zoom is growing, it's amazing. But these things are already priced in. We're priced in for long-term COVID. This is changing the world, and all these new ways of shopping, being on the internet all the time and not leaving your house, is a lot of this is priced in. So these are valuations we haven't seen since 2001, and sometimes they actually exceed some of those crazy valuations where companies talk about putting out electrical vehicles and they don't even have a factory yet, and they've raised, it's got a third there's tech that's TKLA. It's got a market value of $30 billion. Doesn't have a factory. I mean, like some of these things you see this froth in the market in these sectors, and you think, my gosh, this is time to be a little bit more cautious. So we look forward to actually a rotation into some more value sector, and I think we're still waiting for that to happen. So
Chris, I just wanted to raise a question before I go on to the MLP stuff for a couple of minutes. Just go back to, I don't know if Mike can go back to his slides, but it doesn't matter if he can't, because it was regarding basically the value rotation to value. And you also mentioned that the IWM is down today. I struggle a little bit to understand the correlation between value stocks and small and medium-sized companies, or the Russell 2000 more accurately. Because to me, value stocks are not necessarily, like a lot of growth stocks, the next Google, the next Apple, whatever it is, they're small and medium enterprises at some point, and then they go through this incredible
growth. Yeah, exactly. Usually growth stocks are the small ones, right? And they should be growing, right? But a lot of these stocks that we see, there's a lot of, the airlines are now a value play, right? Yeah, more traditional businesses and things like steel, okay? But, metals, basic metals, these kind of things. But so they're in
Russell 2000 as a value index or as a growth index then?
It's half and half actually. There's 2,000, 1,000 of that is growth and 1,000 of that is actually or value. But the issue I think is the value plays we're seeing are things that are beat up. We mentioned before, I think, some of the stuff with the fallen angel, Ford. Today you can talk about U.S. Steel as a value play, right?
Huge one,
yeah. Okay. If things don't go well with travel, if things don't go well with leisure, in other words, people taking vacations and going on cruises, and if things don't go well with the China trade deal, those value plays, right now we see them as value because they're beat up and they're interesting, right? Aren't value at all because, I mean, there's speculation among traders that U.S. Steel could go out of business if it's not floated something from the government. Airlines are out their bailout money. The interest rates are so low, and the reason some of these companies are alive in a zombie state, we talked about this previously, is because they've been able to raise funds from the government to actually buffer their balance sheets in these hard times. They depend on some growth, and no matter what, they become only valuable if the economy kind of returns to normalcy. And that's, I think, the issue. There's a lot of beat up stocks in IWM. And there's a lot of overpriced stuff that is in sectors like cloud computing and internet technology and FANG. And there's just the bifurcation in the market right now that I think is if things are gonna sell off, you're probably gonna see a shift in that dynamic. It's just not gonna be a sell-off of the stuff that's already beaten up anymore. And I think that a lot of these, you see a lot of retail traders from Robinhood and stuff, they were buying Gap yesterday. They're buying like Gap, even though it announced bankruptcy. Hertz last week, they buy it because it announced bankruptcy because they're thinking the US government won't let these companies fail. they'll have a way of bailing them out or something. And so all these retail traders just love to go in and pile into these very speculative value names, hoping for some kind of a government announcement.
I just brought up
Sorry.
I just brought up the. Sorry, Mike. Did you want to talk?
No, I was just going to ask Chris. Are we seeing much as a parallel to value? Are we seeing much going into dividend-paying stocks? I'm just looking at SPHD.
You know what we're seeing? You know what's amazing is we're seeing is, and I can bring this up later, maybe next Friday. We'll look at what's actually hot and what's not. And what's amazingly hot, and it's never been like this. It's never been in the top 25% of where money goes. Is inflation indexed bonds. Yeah, tips. And tips. And tips are like ranked like out of 180 different sectors, they're ranked like in the top 20 right now. So this is like, if you start looking at the dynamics of what people are saying, is like, look, people are beginning to hedge their bets on how much more the government can bail things out. But they're saying if they do start bailing things out rapidly and increase the balance sheet, there was a number this morning that we're going to get to $10 trillion on the Fed balance sheet. We're at 3.8 right now. $10 trillion by the end of 2021. That's just explosive amounts of money in the economy. And inflation is, at that point, we had these conversations before, but inflation, if the economy does come back and starts to grow, there's so much money flooding out the economy out there that inflation will come back. And so people are piling up on cheap right now, cheap tips, these Treasury Index protected securities or whatever. So inflation index protected securities. So they're going to, there are, and that hasn't been in the history of the economy or the history of the world. You haven't had this since these things came out in the 1970s. There hasn't been that much demand for these types of bonds. So I think dividend-paying stocks, quality dividend, Alan, is what people are looking for. Quality dividend,
Which brings us very nicely onto MLPs and midstream MLPs in particular, which we looked at this week. I'm kind of a fan. I mean, I've got quite a few clients in MMP, which is mentioned on there. It's McClellan Midstream Partners, and also Shell, which is the Anglo-Dutch oil company that have SHLX, that's the midstream partners. And both of them right now are paying either double-digit dividend or low double-digit or even in the middle teens, which, the whole attraction is that they're pretty safe, big companies, infrastructures that collect rents, basically. But the problem is that this presentation explained that there was already 12 of the MLPs had cut their distributions so far, I think, this year. So the point is that if something is going to cut its dividend or cut its distribution, how do you assign a value to it? If I buy something that's cheap now, and it pays 12% dividend, and I lock that in, which is great news for the investor, especially long-term conservative investors that want some decent income in their pension time. But then the dividend is cut by half. It doesn't make any sense. So is it still worthwhile looking at? Is it still worthwhile putting some in a client's portfolio?
So this UBS, I watched this a little bit, this presentation myself a little bit, and I think this was what was really interesting about the UBS presentation was the fact that they segregated out the different type of MLPs, right? They said, okay, these ones are at risk. And they name them specifically, and you brought the slide up that shows them, and then they have the ones that they feel are quality, and they did some real in-depth evaluation of these, and I think there's this, we usually play with ETFs around this and don't pick out specific MLPs, but if you were going to do this, there's some research available as to which of these MLPs are actually valuable. We can use some research and analytical sites that we have access to actually see what the prognosis is for a dividend cut. And I think some of this is interesting to show to clients for sure. Absolutely. This is I mean, anywhere now you can get pretty much a guaranteed or close to a guaranteed income of some above 10% is incredible, really incredible. Yeah. You know, a lot of places.
Too good to be true, Chris.
It does look too good to be true, but the hit was back in March and April and May, and as the price of oil is rebounding. I'm not going to say it's going to go back to 100 or something like this. There is an inflation effect that could happen if markets do, you know, if COVID does go away because of the amount of cash floating around. But just without that, I mean, there's plenty of these stocks are beat up, Alan. I mean, these stocks they're 25% of what they cost back in March. And I mean, you know that. So even if they come down with their dividends, you're looking at a potential growth story in the stock itself. So I don't know. I would be selective, but this is an interesting presentation specifically because it brings this sector to highlight. Not a lot of people talk about this sector. I think we've been one of the first who's ever mentioned it. I mean, in Russia. So this is kind of a big thing, and it was interesting that on this. These tax people in Russia that presented last weekend with Veronica, when we talked about dividend and we talked about MLPs, they actually talked about the tax structure around these. So, I mean, there are Russian clients interested in investing in MLPs and are aware of this dividend and aware what they do and are quite interested in this kind of these partnerships. So.
Okay.
Yeah, we have to watch out for withholding taxes for non-U.S. residents because it can reach all the way to 39.6%.
But there's ETFs available with this that are offshore, so we've highlighted them actually in previous discussions and in previous conversations, and they're on our blog. So yeah, it would be interesting to maybe bring that up again. All right, I think that's enough for today, right? We're back at time.